For today's video, man, we have a lot of great information to share with you guys. So right now we're in a real estate investment property. Now, one of our clients recently purchased this particular property, and I'm gonna be sharing with you how we were able to develop a strategy where they didn't have to come out of any money out of their own pocket in order to purchase this particular property. Now, this property is going to be a short-term rental, likely an Airbnb or vacation rental. And so our client was able to get financing for the down payment on this property using business credit. So that includes business credit cards, business lines of credit exclusively for the down payment. And through our network of different real estate lenders, they were able to finance the remaining portion. So I wanted to break down exactly how it works on the real estate investment side when you're looking to purchase a property. Now, typically the process is going to be a little bit different in terms of the data points required to get an approval for an investment property. Now, this is not financial advice. So in terms of the data points that you need to get financing for a real estate property, so the way it works is they're looking at what's called debt service coverage ratio. Right, so debt service coverage ratio, otherwise known as DSCR, it's the proportion of the potential rental income to your debt service. So debt service is basically what it's going to cost you. So your mortgage, so that includes principal, interest, taxes, insurance, as well as any homeowners association or dues that you have to pay. So it's going to be your monthly debt obligation, right? And then the monthly potential rental income and the ratio of that. So with a lot of the lenders we work with, they have a debt service coverage ratio of 1.1. So a quick example, let's say this property right here that we're in, it brings in $1,500 per month in rental income, but with the mortgage, insurance, taxes, homeowners association, let's say it comes to $1,000. So your DSCR would be 1.5, right? So it costs you $1,000 to service the debt per month, and it's bringing in $1,500. So that's 1.5. So according to the lender's requirement of having at least a 1.1, then you're going to qualify based off the debt service coverage ratio. Now, the key distinction between private real estate investment financing is that each and every deal is assessed based off of its debt service coverage ratio. So let's say, on the personal side, let's say you want to get an owner occupied property and, you're putting down 3 to 5%. So in that particular situation, you can get your pre-approval and then go shopping for properties, right? However, with real estate investment financing, every time you put a property under contract and you submit a real estate financing loan application, they're going to be looking specifically at that property. So each property is underwritten separately. So it's not like you get a blanket approval and you can, let's say one deal doesn't work out and you try to apply that financing to another deal. With real estate investment financing, they're looking at the debt service coverage ratio of every property. In terms of the monthly rental income projection, they use very conservative metrics. So let's say this is a short-term rental and we're saying, let's say 50% monthly occupancy. It rents out for $100 per day, but we're only occupied or rented out half of the month, which is fairly conservative. So that's $1,500. They're going to use, local information, right? Look at comparable properties and what they rent out for to really assess what your daily rate is and then give a very conservative, occupancy for the month. Now, can you get it rented out for the whole month? Absolutely. Or, 80 or 90%? Absolutely. But they're using very conservative estimates. So one of the first steps when it comes to real estate investment financing is actually finding a property that you want to purchase. Now, there's a lot of online listings, there's Zillows, there's off-market deals. The first step is putting the property under contract. Now, what do you have to do to put the property under contract? Now, for one, usually you're going to have to demonstrate that you have the ability to purchase that property. So what that basically means is that you have what's called proof of funds, right? So with proof of funds, you basically, let's say you have a pre-approval letter from a lender, you have a proof of funds letter, or if you have the money in the bank, sometimes you can use your bank statements as proof of funds. And so once you establish that, and I'm going to say this, most sellers agents are going to require proof of funds, right? Because they basically don't want someone who's trying to put a property under contract and they really don't have the ability to pay. So that's why having proof of funds is very important when it comes to putting a property under contract, because you have to demonstrate that you do have the ability to pay. So one of the services that we offer are proof of funds letters up to $500,000. Now, once you get that proof of funds letter, you can go out and put a property under contract, right? So once you get the property under contract, you're going to want to secure financing. That's where we come in. We have a host of different lenders. Now, in order to qualify, right, usually you're going to have at least a 680 credit score or higher. Some lenders go below 680, but general rule of thumb, 680 is where you want to be across the board. Now, the way it works is they have what's called loan to value, right? So on the private side, it's not like on, the owner occupied side where you can get, 3 to 5% down payment. Generally on the private real estate investment, you're putting down anywhere from 10%, so 90% LTV up to 65% LTV. Now, typically with the lower LTVs, like 65, 70%, typically that's going to be for newer investors who don't have the experience. Once you have a couple of deals under your belt, you can qualify for a higher loan to value, but the lenders that we work with go as high as 90% loan to value. So that pretty much means you have to come to the table with 10% for down payment, not including closing costs. So you also have to factor in closing costs. But another thing you also want to keep in mind is that a lot of the lenders we work with also want to see how much deposits you have net of your down payment. So essentially they want to see that you have at least 6 months of reserves. And the reason why they want to see that is because they want to make sure that you don't go belly up right after you close on the deal. So at least you have 6 months of reserves to put towards your debt service. And you don't necessarily need to have $6,000 in cash in this particular example, but let's say you have some business lines of credit that you could just show that you have access to this capital. In a lot of situations, we're able to facilitate that so you meet that qualification. In addition, using business lines of credit and business credit cards for the down payment. So there's a couple of different steps with this. And I'm gonna show you how to be able to get a turnkey real estate investment property with no money out of your pocket. So it involves using business credit cards, business lines of credit, utilizing that to, in certain situations, purchase the property outright, or for your 10 to 20% down payment on your real estate investment property. And again, this is business credit, does not report on your personal credit. So it's not going to increase your utilization. In a lot of cases, we can get these business lines of credit for you with absolutely no hard inquiry. So imagine that you're able to purchase Airbnb or short-term rental property that's going to generate $1,500 per month. All you need to do is make sure you have at least a 680 credit score and you have a business LLC, because remember, the properties are going to be generally titled under your business entity. So we'll walk you down how to align your data points so you can apply all of these different financial tools. They're looking to turn this into an Airbnb or short-term rental property. Definitely a great property, and they were able to get this property no money out of pocket, not even using their own money for the down payment. They use business credit to get business assets that's going to generate passive income for them. And here's another thing too. They'll use the rental income to pay down their mortgage.